Steve, thank you for joining us today.
You're welcome, Frank.
What are the factors that distinguish captives from other forms of risk retention and risk financing?
Frank, captive insurance is really a form of self-insurance. It allows it allows a person with risk, let's say a corporation typically, because individuals don't form captives, it's always companies, that have maybe some unique risks or risks that are challenging in terms of placing or the cost is prohibitive, of taking that risk, self-insuring it, but using it instead of just setting aside a bank account, right, or a savings account to pay any claim costs that may be associated with that risk, using a captive insurance company to better finance it in a more efficient manner.
Is it fair to say that captives allow companies to reduce their total cost of risk?
It can. It can. What it allows a captive insurance company does is better to manage that risk. We oftentimes like to say that captive insurance companies are used to finance risk, which is an appropriate way of categorizing the use of captive insurance. Again, it is setting aside your dollars through a form of self-insurance, but in a more efficient manner by using insurance.
Steve, is the captive formation process arduous? What does that look like?
Well, the formation process, in terms of being arduous, I would better categorize the question as, is it detailed? Do the regulators look at the application that is submitted by a captive insurance applicant? Yes, they do. But at the same time, in Oklahoma, at the Oklahoma Insurance Department, Glenn Mulready, the insurance commissioner, says, we're not just regulators, we're also educators. So we want to help the applicants in terms of developing the best application possible. Now, not all applications will succeed. Not all applicants, probably in any category or area of insurance, will succeed at all times. But we want to make sure that the applicants are as successful as they can be with the help of the Department of Insurance.
Given all that goes into forming a captive, do they require a long-term commitment? Can you give us a sense for that?
Yes, I would say a long-term commitment. At a minimum, a captive insurance company should be considered for at least 5 years. Now that may be dependent also, Frank, on the type of risk that are involved. There's a certain liability risk, which is a term we like to use in the insurance industry called long-tail risk. The liability extends out for years. And of course, the captive insurance company will be in existence far, far longer. But if it's a property risk on a year-to-year basis, you'll know if there's a hurricane or not, or a tornado, and damage from that. Those claims can be paid quickly, whereas a liability claim may not arise for many, many years. But typically I would say is a captive should be considered at a minimum of 5 years.
Historically, is it true that captives were almost all domiciled outside of the United States? And what does the domestic market for captives look like today, Steve?
Well, it's a very vibrant domestic market today. We have over 35 states now that have adopted captive insurance laws and are offering captive insurance to companies in their state. Insurance Commissioner Mulready wants the Oklahoma Insurance Department's captive insurance program to be a tool that Oklahoma-based companies can use for their risk transfer needs. But not just Oklahoma-based companies. He's certainly looking beyond the borders of Oklahoma to allow many others beyond those borders to use captive insurance via an Oklahoma captive domicile and to manage those risks, to manage that risk transfer.
Can you talk a bit about how captives are regulated? Is it fair to say that the regulatory environment for captives is unique?
I wouldn't call it unique, I would call it different. It's a different set of laws, and there's a reason for that. Captive insurance companies do not offer insurance to the public. In other words, captive insurance companies in Oklahoma and most other states are prohibited, for example, from issuing personal automobile coverage or homeowners coverage. That's better left to companies like State Farm or Farmers Insurance or Allstate that are better suited for that. Captive insurance companies are typically used for commercial insurance purposes, again, by companies that seek to cover their own unique risks. And the laws have been developed to recognize that fact in the captive insurance world because, again, it's a form of self-insurance, and distinguishing the laws that apply to captive insurance company versus the laws that apply to those that sell personal auto, homeowners, or to third parties, the laws take those differences into account.
For financial regulators, specifically those concerned with solvency regulation, I'm curious, can you speak to requirements related to minimum statutory financial capital?
All captive domiciles have minimum requirements for various licensing types. For example, a pure captive in Oklahoma, or as in Delaware, would be capitalized at a minimum amount of $250,000. So that is the amount of capital that must be set aside to get the captive started. However, we also look at various leverage ratios. Most captive domiciles, not all, but most, use, for instance, a 3-to-1 premium to surplus ratio. So for every $3 of premium written, there must be $1 of surplus, which again is a means for ensuring the captive is solvent.
Steve, would you distinguish captives from surplus lines?
Well, the surplus lines market is one that, again, is designed for risks that cannot be placed in the commercial market. But one major difference is this. In captive insurance, a captive owner or a company will have very, very unique risks that may be solely for it. Maybe, for example, Side A directors and officers insurance, right? Because there are certain characteristics, or maybe there's a controlling shareholder on the board of directors. That particular specific need cannot be filled, and may not be able to be filled in the surplus lines market, and as a result, captive insurance is the way to do that. Or maybe for cyber insurance coverages, right? Maybe to fill gaps in a commercially purchased cyber insurance policy, the captive is formed to fill the exclusions, to cover the exclusions in that commercial coverage. That's oftentimes known as difference in conditions. There are some similarities between the excess and surplus lines market, but there are also some differences between the excess and surplus lines market and captive insurance.
For lawmakers and regulators who are interested in learning more about captives, can you suggest some resources?
The Griffiths, the institutes, the website is a good place to start. The NEIC has some materials regarding captive insurance. I would look at state associations like the Oklahoma Captive Insurance Association and other trade associations like the Captive Insurance Companies Association, otherwise known as SECA. And of course, there are always the websites of individual insurance departments, which will be specific to captives domiciled in those states, like the Oklahoma Insurance Department's website, and the information on it will be applicable to Oklahoma domiciled captive insurance companies.
Steve Kinion, we thank you for visiting with us.